Welcome to this video. We are gonna talk about liquidity. Let's start with the terms because you hear me say liquidity curve and return to zone all the time. So I want to explain to you what that means. So we now have a range and we now have a slow pacing price action. Okay, so if we have slow price action, this means we leave a lot of liquidity, a lot of stop losses above the highs. And if we have a lot of liquidity, we can create a liquidity curve. And if you see a liquidity curve on my charts, it just means there is enough liquidity to push higher prices eventually. And that said, it also means we will have a great return to zone as well. Why? Because what are zones? We have zones on the bottom side of the range, and we also have zones, price levels, at the upper side of the range, right? So what does this mean? If we have a good return to zone and we have a good entry down below or on the upper side, and we have a good return to zone, it means we have a great opportunity to go long at the bottom because the price can return back to the upper zone very easily thanks to the liquidity curve. And I will show you this in the next videos. But for now, we are going to talk about what is liquidity and how can you spot it. We are going to especially talk about primary highs and eternal highs. So I want you to know that the primary highs are the most important and the internal highs are not really relevant. And I will explain to you why. The reason for this is if the price comes down from here to here and it creates a new primary high like this, where do people put their stop loss? They will always put their stop loss above the primary highs. So if the price, let's say this is a 4-hour chart, and we zoom in and we see primary highs on the 15 minutes, but it's just a eternal high on the higher time frames, of course, it is liquidity, it is relevant on the lower time frames, but on the higher time frames, targeting wise and return to zone wise, primary highs are the important part. So let's go for an example. Imagine if we have a if we have a pivot point like this. So we call it pivot point if it is the most important point on the chart where the price reversed. Okay, so here we got a, let's call it a small relief rally. This is the pivot point, the point that the price pivoted down, and it's obviously a very important part in the trend. But you need to understand if traders, if people take shorts on the way down, so people go short here, and go short here, where do they want to put their stop losses? Well, of course, they will trail, but the biggest stop losses will always be above the pivot points. Why? This is just a simple invalidation of the market structure. So it also makes a great magnet for the price to manipulate. Okay, so sometimes if people put stop losses here, we take out the high before we go lower. I think most of us know how this works in real life, but this is the reason for it. Why? The reason is liquidity. But it doesn't need to happen because if we're building a liquidity curve with a lot of primary highs, it is just a sign that the price can easily return back from the bottom zone to the high upper zone. Okay? In the previous video, I learned you about level 1, 2, and 3. you can think about it for primary highs or lows like this as well. So let me explain. It all depends on the time frame you want to be trading on, right? So if you are trading a range on the 4-hour chart, let's say this is the range like this, and this is the first leg of the range, and you want to find liquidity, you need to know what the primary bottoms are. Okay, like this, primary lows. It is important that these lows at the 15-minute also are primary lows. And on the 5 minutes, these are also primary lows. But it are only primary lows if you want to trade on the 5-minute time frame. So let me put it like this. If you want to go short right here, let's say we are wanting to short, and we are targeting the 5-minute lows here as primary lows, this will be the short setup. So the price might trigger all the liquidity on the 5-minute, but it bounces here and the price goes back up, for example. Well, if you targeted the lows, let's say you targeted here, but you are looking at the 5-minute chart, obviously it doesn't make any sense because the liquidity is triggered and now the price is going up just to create another primary low on the 4-hour. And this will be the chart later on, okay? So the 5-minute is swept, the 5-minute liquidity is gone, but the 1-hour and the 4-hour, sorry, the 50 minutes and the 4-hour are still there. So this is why you really need to understand, if you have a 4-hourly range, that you put the primary lows of the 4-hour instead of the 5-minute, because your target will fail if you have the context not in place. Okay, I hope this makes any sense to you at this point. Let's move on. Now let me give you an example of why a return to zone and liquidity is important. So imagine you have been to a restaurant and your car is outside, you're done with your dinner, you're getting into your car and you want to go home. If you want to get home, your car needs gas. Without gas, the car won't drive and you will never get home. Makes sense? So if we take that analogy to the charts, and let's say we have low 1 and we have a second low and we have a third low, we are reclaiming the range at this point and we want to go long. And long in this case is we want to go back to the old zone or home. Okay, we want to go home, but we need gas. So if we have a good liquidity curve like this with many primary highs that aren't taken by the previous highs, and we have also internal highs ready to get pulled or pushed like this all the way down, we know, okay, now we have a lot of gas in our car and we will get home easily. And we will have a great setup like this. Now imagine if in the range, for another example, we don't have gas and we already took liquidity all the way. So we took liquidity here, we took liquidity here, like this, and we are leaving a lot of supply zones. Okay, so we have a lot of supply zones in between, which means supply is always a very, very heavy resistance level. So now the liquidity curve we had isn't valid anymore, and there is no real liquidity curve. Yeah, there is some liquidity. I mean, we do have primary highs like this, but we also have a lot of supply. So the quality of this long trade goes down a lot, and you don't want to be taking this at this point. Okay, because there isn't enough gas in our car to go up at once. And at last, I want to teach you the most important thing and that is, what is a quality return to zone? And it is about supply zones. Okay, because in a supply there is heavy demand for lower prices. I mean, the sellers want to push the price down at those points, right? That's why it's called supply. So imagine we have a huge supply zone right here. And if you don't know what a supply is yet, we are going over that in the next video. So you will understand what it means. Okay, so now we still have a great return to zone. But now we have added supply zones. And if we leave those supplies open, like I told you 1 minute ago, like this, and also like this, we have now 3 places of resistance from the upside. So to the upside. So it's really difficult to go up if we need to break those supply zones. So when do we have a quality return to zone? That is if the price mitigated the supply zones already. So if the supplies are mitigated like this with a wick or just have been tested for a while, the supply zones are not that valid anymore. Yes, it is still supply, but because it's tested, if we come back to the supply later on, we won't have a hard time to push through. Okay, so what do we want to see for a quality return to zone? We want to see that the price did tap, and we mitigated the supply like this. And also, if we have a supply here, we would like to have mitigated it already like this. Boom. And now the supply zones, we do have a great liquidity curve. We don't have any strong supply zones above, and this makes that the price can break through really easily. So now we do have a quality return to zone. Okay, so this is it about liquidity in ranges. All you need to understand is what are primary highs, what are internal highs, and what is a quality return to zone. So to summarize, it is of high quality if the supply zones in between are already mitigated, and of course the range quality gets up if we have a great liquidity curve. Thank you for watching. In the next video we are going to talk about supply and demand. I will see you there.